So let me welcome on board Sanjeev Prasad, MD and CEO, or rather co-head at Kotak Institutional Equities, to chat about where he sees the market headed from here. Sanjeev, hi, good morning. Good to have you on the show. Sanjeev, first things first, just wondering how is it that one approaches FMCG right now? Because, even after Unilever's commentary yesterday, it seems like the damage is somewhat in the price. I mean, market has been toiling with input cost pressures for FMCG for almost 2 quarters now. Time to buy FMCG, you think, or still an avoid?
If you're looking at a market which probably will not give a great deal of returns from where we are, that's our central in the case for the next 6 months, given the macroeconomic outlook, expensive valuations, interest rates going up, inflation staying high, and so on and so forth, then I assume consumers will fit okay in that kind of a scenario. In the sense, they will hold up along with the market. And if there is, for any reason, a very stiff correction in the market, for whatever reason, most related to less escalation of tensions on the Russia-Ukraine conflict, maybe consumers may hold out slightly better. So that's probably the portfolio positioning you should look at as far as consumers are concerned. I don't think there is a lot of money to be made here from current levels for most of the FMCG names, given the fact that valuation is too expensive. You're seeing a lot of issues on the demand side. Profitability will continue to be under pressure given RM-led price increases and so on and so forth. So all that means, it's unlikely stocks are going to perform in a positive way from where we are. It's just that if you want to protect the portfolio from any downside risk, then maybe FMCG fits the bill okay in that kind of a scenario.
What about autos on the other hand, Sanjeev? Although off late one has been seeing a fair amount of buoyancy, especially in the two-wheeler space. But given the fact that the geopolitical tensions have once again brought to the fore the demand-supply dynamics and supply chain especially getting impacted, with commentary coming in from most of the majors that semiconductor chip shortage once again has come to the fore, and it's seeing a very lingering impact post-COVID now because of the Ukraine-Russia war. And that said, the input cost pressure in any case has been weighing heavy. So just wanted to understand, how is it that you're maneuvering the auto universe now?
See, autos, anyway, you need to look at the 4 segments separately: two-wheelers, four-wheelers, CVs, and tractors. At this point in time, CVs and tractors seem to be slightly in a better position. Tractors, assuming you have a normal monsoon, with some increase in food prices of late, given global factors, and also the fact that the government may have to increase MSPs a lot more this time around. Hopefully, rural economy has turned the corner, things will start improving over there. So in that context, maybe tractors should be okay. If you come to CVs, I think we are probably the start of a long cycle over here. And again, despite all the RM pressures, etc., if volumes were to come back, some of the challenges on the margin side could get absorbed. So I think CVs are also okay, I would think. On two-wheelers, four-wheelers, you are seeing challenges not only for companies, given all the factors that you highlighted, RM price increases, on top of the supply side disruption, which continue for some more time. We're also seeing challenges for the consumer, given the cost of ownership has gone up significantly the last 2 years, given a combination increase in the ASPs of two-wheelers and four-wheelers. All the input costs have gone up, so companies have no option but to raise prices. And at the same time, the diesel and petrol prices have gone up and probably will go up further, given the fact that the marketing companies are losing money currently. So given a combination of challenges for companies and customers, I'm not very sure two-wheelers and four-wheelers are in exactly a good position over here. And also valuation not that supportive. Stocks haven't done much for the last 3-4 years now as far as two-wheelers are concerned. But anyway, we have longer-term challenges also for this segment, in the sense penetration levels are very high. You're already seeing a lot of disruption coming from EVs, and profitability is very high. So given that combination, anyway, we have not been very big fans of the two-wheeler industry for the last 3-4 years, and I think the longer term challenges will persist. In the shorter term, you will probably see some demand recovery, but given the headwinds of RM pressures and continued challenges for the consumer, I'm not too sure I can make a great case for two-wheelers currently.
Good morning. This is Nantara. We did an editor's take with Nikunj Dalmia on top of the show, which is that this earnings season, what we've seen is the large caps, which are FI dominated. What has happened with them? Look at the HDFC twins. Look at what happened with Bajaj yesterday, for example. There's Infosys as well. What do you make of this? What's happening this earnings season with these FI dominated stocks?
I don't think it's a case of this earnings season. It's been going on for the last 6-7 months now. FIs in general have been selling India for whatever reason, mostly I guess linked to a combination of high valuations and deteriorating macro. They have taken a negative view on India and they've been selling consistently for the last 6-7 months now. So I don't think it's got anything specific to do with the stocks you name. It's just that they want to probably lighten up, and those are the stocks they own in India, and that's why you're seeing continued selling on those names. I guess maybe they're finding better opportunity in other parts of the world. Last year that was China, maybe this year it is Brazil. And India doesn't stack up very high when I speak to investors in the pecking order for emerging markets as of now. It's just a valuation are very high. Interest rate cycle in India is just starting, and especially for the stocks that you want to own, all the consumption names, etc. Valuation are high, and probably you will see some downgrades also. So that's probably the reason why FIs have been very negative on India and generally been selling the stocks that they own.
Okay. Now, we are, of course, in the thick of earnings season. And in this earnings season, the margin compression, which you did talk about, nevertheless, what we understand is that you're expecting the net income of the Nifty-50 Index to increase 27% year on year. So with having said that, what is it that you folks are betting on?
Not sure where you got the number from. For FY23, as of now, we have about 18% growth. For FY22, we have 38%, but that's largely done. So 70% is still a very good number, I must say. That is largely coming from sectors such as banking, oil and gas, and telecom. Banking, it's easy enough to understand, loan loss provision numbers will decline as we go forward. PPOP will rise in line with total income. And, given a favorable combination over loan loss provision, higher PPOP, the PPT numbers will go up and PAT will accordingly rise. So that explains banks. Oil and gas, again, a simple thing to understand. Oil prices are high, gross refining margins are, amazingly high. So all that will drive the profits of the upstream companies. There's also Reliance. Downstream companies, there's only BPCL now in the Nifty-50 Index. Obviously, you will see some challenges on the marketing side, given the fact that the marketing company is still making losses on sales of diesel gasoline. And telecom, which also benefits Reliance, you anyway have seen one round of ARPU increases in November, December of 2021. So that will percolate into big increase in earning numbers for FY23. And I suspect you will probably see one more round of ARPU increases sometime, or tariff increases, I should say, sometime in, November, December of 22 also, which will again lead to one more round of earning increase for FY23 and FY24 also. So that's what is driving, earnings for the market as a whole. As of now, we have assumed some decline in realization for the metal and mining companies. So far, spot prices are, somewhat higher than our assumption. So if anything, you could see some upside risk to the numbers for the metal companies also. On the other hand, we have already downgraded numbers for the consumption sectors. Autos, in particular, is also consumer staples, consumer discretionary, given the pressure on gross margin. So hopefully, that's there in the earning numbers. Maybe there could be some more downgrades, but I think largely that seems to be factored in, I would say. Unless until, for whatever reason, RM prices, spike. I think we are reasonably well protected on the earnings of the consumption sectors.
Right. Sanjeev, I was quite intrigued to see the way the market reacted to Bajaj Finance's strong numbers. I mean, and I'm looking to see if any brokerages downgrade the stock. Of course not. They continue to maintain their buy and outperform ratings. Then what explains this kind of a reaction on the stock yesterday? I mean, is it priced to perfection?
Yeah, I guess so. If you look at the stock at about 7,000 rupees, it's trading at about 8 times FY23 book, about 6.5 times 24 book. Before COVID, if I remember correctly, this used to be in the low sevens. So actually, the stock is on a 1 year forward basis, that is. So it has already seen some relating over the last, 1.5 years. I mean, the company is obviously executing, amazingly well. The loan growth will be in the, mid-20s range. So all that is a given. But it's just that, a lot of good news is priced in. Valuations have, leave no scope for any disappointment. I guess there was some disappointment maybe on the digital strategy, so since the company announced that it is also now falling into the web-based strategy, there's some, I don't know whether the right assumption with the market has made that maybe the app offtake is not that great, which is also forcing the company to maybe look at the web strategy also. But I assume ultimately the company has to look at all channels, and that could be the explanation for that. But I assume everything is priced in over here. With respect to loan growth, respect to digital strategy, and just the room for disappointment is very, very limited.
The other set, of course, Sanjeev, is the behemoth which HDFC Bank is going to create, and the kind of underperformance since day after the merger that we've seen in both the stock prices. Although the management seems to very clearly say that, they weren't able to articulate the the benefits as well as the synergies of the merger because they were stepping into their earnings, and that's why the market misunderstood it. And they're pretty confident that the stocks are going to make up for all the losses. But would you think that the underperformance is going to continue till the MSCI issue and the adjustment gets resolved, until we actually see the merger fructify?
It's hard to take a call on how stock price will behave. But the stock does, both actually look very reasonably valued, I would say. If you look at an HDFC Bank in isolation, it's about 3 times on 1 year forward book. And if you look at the combined entity, whenever HDFC HDFC Bank come together, hopefully probably towards the end of FY24. And if you look at the combined book, it could be somewhere about 600 rupees. So that is, I'm talking about HDFC Bank post merger of HDFC to HDFC Bank. And if you take out the value of all the, the associate company subsidiaries, etc., then in that case, HDFC Bank combined entity will be available about 2.2 times FY24 book. So valuation is actually pretty reasonable, I would say. The combined entity will continue to deliver, ROE in the range of around 15 to probably 16%, maybe slightly higher over a period of time. If I put everything together, I am a bit surprised as to why the market has reacted so negatively to the merger announcement. I think from an HDFC perspective, it makes perfect sense because the asset size has become quite large, and at some point in time, it would make sense to have a much more stable liability base. And the RBI would also be a lot comfortable if a large institution, or an NBFC has, as a stable liability base. So from an HDFC perspective, clearly it makes a lot of sense. From an HDFC Bank perspective, they have got a very, good mortgage business, the best in the country, at a very reasonable price. So, even though there will be some dilution in the growth and ROE profile of HDFC Bank, it's not as such overpaid for the mortgage business of HDFC. And ultimately, you have to look at ROE on a risk-adjusted basis, right? Obviously, the mortgage business will have lower ROE compared to a personal unsecured loan business, but on a full cycle, adjusted for credit costs, etc., a mortgage business is as good as any other business. So I think probably the market seems to have, misread this whole, change in the asset side of HDFC Bank and what it could mean for the ROE and ROE. But ultimately, you have to look at everything on a risk-adjusted basis when it comes to a lending business. So I'm actually quite okay with the merger.
Okay, so that's Sanjeev Prasad with his take as far as that big merger goes. It is the season of M&As, isn't it? We've heard from the HDFC twins.